MTN SME Hub. Link to growth. Link to success. Link to the ultimate resource for business advice and insights.
Welcome back to the Big Small Business Show. In studio with us today, we've got George Diab. He's the founder and CEO of Gas Accounting, and they are specializing in the medical industry in terms of doing the financials and accounting for that industry. And we've been talking about the difference that these types of businesses, doctors, dentists, and the like, have in terms of the practical day-to-day running of their businesses, and in particular the difference at the end of their careers in terms of their ability to sell what they can sell for, and the risks that are associated with running a practice. So you touched on this concept of protective structures, right? I'd really like to unpack that more. If I'm a doctor watching this right now, and I'm thinking, do I have enough protective structures in place? Or what would I need to be putting in place? And let's also talk about the risks associated and, of course, the tax implications as well.
Sure. So it's a journey, right? So when you're starting off and you go from government into private, you typically start as a sole proprietor.
Right.
And then you start trading as a sole prop, and the next step in that journey becomes to register for VAT.
Yeah.
Right now, one of the big things for
so doctors have to charge VAT as well.
Absolutely, yes.
Okay.
Yeah, it's a taxable supply, and it's actually really bad for them. So in most cases, if you register for VAT, you take that 15% or 15.5% now, when you just charge that onto your client, right?
Right.
But because doctors are contracted into the medical schemes, the medical scheme pays an all-inclusive rate. So let's say the medical scheme pays R1,000 for this procedure. When you're not VAT registered, you get the R1,000 and you keep it. When you are VAT registered, you get the R1,000, but now you've got to pay 15.5% directly over to SARS. So it automatically chops out 15.5% of your profitability.
Sure.
So you want to delay that as far as possible.
Right.
But you can't really get away with it for too long. Then we go from a sole proprietor and then we register incorporated. And we do that solely because of an income tax decision. You don't want to pay tax at 45%. Let's rather pay tax at 27%. And the difference, that 18% difference, becomes investable. So
Right.
we don't, it doesn't necessarily mean that we won't pay tax on that later, but we're just deferring that tax. So we've got more cash flow within the business so that we can invest it into the growth or whatever other investments that we're looking at. Then the next part of the process, and this is the one that people forget about, is estate duty. So estate duty is not what you pay when you go buy a house. That's what you pay when you die. It's called the death tax. And working with doctors, they all know you can't escape it. At some point, you're going to die. But when you do, and they wind up your estate, there's a 20%, sometimes 25%, depending on the value of your estate duty that gets paid to SARS. Now, you know that's going to happen. Like, we're not disputing whether or not you're going to die. You are going to at some point. So why not plan for it right now? And if you get your planning right, then when you pass away and you've got your wealth or the value of your assets sitting in the right structure, you don't pay a cent of estate duty. Like, everything goes to your loved ones, your children, your beneficiaries, without incurring any estate duty.
And is that a trust?
That would be under a trust structure. So what we do is we set up a trust structure with the holding company underneath. And it's really important as well, like, you shouldn't be buying your assets in the trust. The assets should be purchased in a holding company under the trust, because trusts are also taxed at 45%. Companies are taxed at 27%. And under that holding company, then we have your various investment companies and your practice management company where you operate your business out of. And by doing it that way, what we're securing is, firstly, we've got your wealth sitting in a structure that's protected. So if there is a legal claim against you, your majority of your wealth or your assets are sitting within a trust. So it's very difficult, if not impossible, to pull those assets back into any type of legal dispute. Secondly, we're optimizing your tax through really nice tax structures. And finally, we're taking your estate duty from 20% all the way down to zero, which means you're saving a lot. And over time, what we find is the doctors do accumulate assets. They do have houses and investment properties and, really good investments in RAs or portfolios. So that the wealth grows naturally without you even trying.
Just let's talk about the risk. You spoke about risk mitigation. So I get the tax part there, but you spoke about the fact that you're required still to be liable for any faults that you make as a doctor.
Yes.
So how is the structure going to mitigate any risk?
So if you now have all the wealth in your own personal name, or you keep it in your Inc., or you've got it in your personal name, and there's a claim against you, they can attach any of those assets in that claim if there's not enough money, right?
Right.
But if those assets are actually sitting in a trust, that's not in your name. And what's really important in this process is how that trust is administered. It can't be an alter ego of yours. It needs to be properly administered. And if that's the case, then it's impossible. It's virtually impossible to pull any of that wealth, any of those assets back into any type of legal dispute. There's a very special way that we go about doing it that's in line with obviously SARS regulations and the HPCSA. And ultimately, the goal over there is to protect your wealth from any type of legal disputes, but also predominantly ensure that you don't pay estate duty.
Last-ish question from me. If you're a new doctor watching this, okay, and you're let's call it a 50-something-year-old doctor that hasn't done all this now, what advice would you give in less than 2 minutes? What advice would you give to the two different types of doctors at different stages in terms of what to do, what's the next steps to do, given one hasn't and one is about to?
Yeah. So to the new doctor, what I'd say is set it up correctly from the beginning. There's a best practice approach to go through this. So if you've got a patient that comes in, you've got your best practice approach of how you should treat them. It's exactly the same with running your medical practice. You go from a sole prop to an incorporated to your trust structure. There's certain trigger points, and you go with the process. Don't go for the cheapest. I found that quite a lot, because what happens is we then get the doctors, and they've got massive tax dramas that you've got to sort out. So start correctly from the beginning with a trusted advisor, someone who specializes in the industry. For a doctor who's been, that's 20 years plus in practice and they've already accumulated this wealth, it's never too late to start. So draw the line in the sand, and what you end up doing is you find the most tax efficient way of putting your wealth in a protected structure, or in a more tax efficient structure. We've got a doctor that's similar to what you're describing now, and he's still trading as a sole prop. And we did a calculation for him, and we said just in the one tax year we saved him about 670,000 rand in taxes. And for him, it's an absolute cash flow relief, because he's dying having to pay SARS, PAYE every single month. And there's far better and more efficient ways to do this that protects cash flow so that you can operate your business, but builds long-term wealth preservation.
George, that was very insightful. And, for any doctors or medical specialists out there who've been watching this, I'm sure it was as illuminating as it was for me. And I hope you do follow that advice to get the right advisor, go and do the right things, and make sure that you're not overpaying tax, and making sure that you're putting stuff aside for the future. That's it for today's show. A very different show, very specialized show. I hope you enjoyed it. And do remember, as always, if you think it, write it down and make it a reality.
The Big Small Business Show, proudly sponsored by MTN Business.